Right now, families are paying hundreds of thousands in capital gains taxes when they could pay zero, and the IRS explicitly allows it. Welcome back to Tax Shield Research Team. I'm your host, and today we're diving deep into one of the most powerful and least discussed tax strategies in the entire U.S. tax code, the step-up basis rule. This mechanism has saved American families billions of dollars in capital gains taxes, yet most people have never heard of it. By the end of this video, you'll understand exactly how this works, why it matters for your inheritance planning, and we'll walk through real-world examples showing how a $500K portfolio could be completely tax-free to your heirs. What is step-up basis? Let's start with the fundamentals. Step-up basis is a provision in the Internal Revenue Code, specifically IRC Section 1014, that allows assets to be stepped up to their fair market value on the date of the original owner's death. This is one of the most underutilized tax benefits in America. Here's how it works in simple terms. Imagine your grandmother purchased Apple stock in 1985 for $500. By the time she passes away in 2024, that stock is worth $150,000. Under normal capital gains taxation rules, if she sold that stock before death, she would owe capital gains taxes on the $149,500 gain, potentially $22,425 in federal taxes alone at the 15% long-term capital gains rate, not counting state taxes. But here's where step-up basis changes everything. When your grandmother passes away and that stock transfers to you as her heir, the basis, or the cost foundation for tax purposes, automatically resets to $150,000. The fair market value on the date of death becomes your new starting point. If you then sell that stock immediately for $150,000, you owe zero capital gains tax. That $149,500 appreciation, it's completely erased from a tax perspective. According to the Congressional Research Service, step-up basis resulted in approximately $45 billion in foregone federal tax revenue in 2021 alone. This isn't a loophole in the illegal sense. It's a congressionally approved mechanism that's been part of the tax code since 1926. The real-world impact. Case studies. Let me show you exactly how this plays out with actual scenarios. Case study 1. The real estate inheritance. Consider the Thompson family from California. In 1995, they purchased a rental property in Los Angeles for $350,000. Through appreciation and a strong real estate market, by 2023, that property is worth $1 million. If they sold it during their lifetime, they'd owe approximately $263,250 in federal capital gains taxes on that $175 million gain, plus California state taxes, bringing the total to roughly $330,000 in taxes owed. But the Thompson family waited. When the father passed away in 2023, the property was valued at $1 million under step-up basis. When his daughter inherited the property, her cost basis automatically became $1 million. When she sold it 6 months later for $15 million, she only owed taxes on the $50,000 gain, approximately $7,500 in federal taxes instead of $330,000. That's a tax savings of $322,500 on a single property. Case study 2. The tech stock portfolio. Take Robert, a Silicon Valley engineer who joined Microsoft in 1995 when stock grants were valued at $40 per share. By the time of his death in 2023, Microsoft stock had appreciated to $370 per share. His 10,000 shares represented a $3 million gain on his original $400,000 investment. If Robert had sold during his lifetime, he'd owe approximately $495,000 in capital gains taxes. But because he held until death, his heirs inherited with a stepped-up basis of $7 million. When they diversified and sold portions of the portfolio over the following year, nearly all of that realized gain was tax-free. The family preserved nearly $500,000. Case study 3. The art collection. Consider Margaret, a collector of contemporary art who purchased works throughout the 1980s and 1990s for a total of $180,000. By 2024, her collection was appraised at $1.8 million. If she wanted to liquidate her collection during her lifetime to leave cash to her heirs, capital gains taxes would consume approximately $243,000 of that appreciation. Instead, Margaret held the collection. Upon her death, the step-up basis rule meant her heirs inherited artwork valued at $1.8 million, with that valuation as their cost basis. When they sold pieces to fund her charitable wishes, they paid minimal capital gains tax on the proceeds. ### How IT applies to different asset classes. Step-up basis works on virtually any appreciated asset you can imagine. **** Stocks and mutual funds. ***. This is where step-up basis creates the most dramatic savings. Long-term investors who have held positions for decades often see massive unrealized gains. Warren Buffett's famous position in Berkshire Hathaway, if held to death, would receive a stepped-up basis worth tens of billions of dollars. His heirs' cost basis would reset to the death day value rather than his original purchase price decades earlier. ***. Real estate. ***. Property typically appreciates significantly over time. The National Association of Realtors reports the median home price has increased over 6% annually on average over the past 50 years. A home purchased for $100,000 in 1975 would be worth over $800,000 today in Most markets. The step-up basis on that property could save heirs $100,000 plus in capital gains taxes. ***. Business interests. ***. If you own a business valued at $5 million that you built from scratch, step-up basis could save your heirs $750,000 plus in capital gains taxes when they inherit it. This is crucial for family business succession planning. ***. Cryptocurrency and digital assets. ***. This is increasingly relevant. An investor who bought Bitcoin at $300 in 2013 and held to 2024 would have an unrealized gain of over $2.4 million per Bitcoin. Step-up basis applies to digital assets as well, though documentation and valuation can be more complex. ***. Collectibles and personal property. ***. Vintage cars, jewelry, wine collections, and art all qualify. If your vintage Ferrari was worth $50,000 when purchased and $500,000 when you pass away, your heirs inherit with a $500,000 basis. ### The mechanics. How the IRS values assets for step-up basis to work. The IRS needs a valuation of the asset on the date of death. Here's how that process works. For publicly traded securities, this is simple. The IRS uses the average of the highest and lowest quoted selling prices on the date of death. For stock trading between $145 and $155 on the date of death, the valuation would be $150. For real property, the estate typically hires a professional appraiser. The appraiser conducts a full valuation following the uniform standards of professional appraisal practice. This value becomes the official stepped-up basis. For business interests and closely held securities, a business valuation expert must determine the fair market value. This involves analyzing financial statements, comparable transactions, market conditions, and growth projections. For small business valued at $1 million, this might cost $5,000 in appraisal fees, a small price for potential six-figure tax savings. For collectibles and personal property, the estate uses values determined by qualified appraisers. For art, this often means consulting auction houses or established art dealers. For vehicles, it might mean consulting classic car valuation services. ### The counter-argument. Future policy changes. Now it's important to acknowledge the criticism of step-up basis. President Biden's administration has proposed eliminating or modifying this provision multiple times. Some economists argue it's unfair that capital gains can escape taxation entirely when assets pass through death. The argument goes like this. If a billionaire holds assets their entire life without selling them, they avoid taxation on hundreds of billions in gains. Their heirs inherit these appreciated assets tax-free. Meanwhile, wage earners pay taxes on every dollar earned. Is this fair? Proponents of reform suggest alternatives like a carryover basis system, where heirs would inherit the deceased's original cost basis and owe capital gains taxes when they eventually sell. This was actually the law from 2010 to 2011, before Congress reinstated step-up basis. Another proposal is a mark-to-market approach, where unrealized gains at death would be immediately taxed, similar to how some countries handle inheritance taxation. However, as of 2024, step-up basis remains fully legal and part of the tax code. Tax policy is inherently political, and these changes require congressional action. Until that happens, step-up basis is a legitimate strategy available to all Americans. Practical planning strategies to maximize step-up basis benefits. Consider these strategies. Strategy 1. Hold appreciated assets. If you're in good health and have a long life expectancy, holding appreciated assets rather than selling them can preserve them for step-up basis treatment. This is especially powerful for highly appreciated securities or real estate. Strategy 2. Avoid gifting appreciated assets. If you gift an appreciated asset during your lifetime, the recipient generally inherits your cost basis, not a stepped-up basis. So if you gift that Apple stock worth $150,000 with a $500 basis, the recipient gets a $500 basis, not $150,000. They'll owe taxes when they sell. Instead, hold until death for step-up basis benefits. Strategy 3. Document valuations. When someone passes away, you'll need to value the estate for tax purposes. Keep documentation, appraisals, and records that substantiate asset values. This protects against IRS challenges and ensures accurate stepped-up basis calculations. Strategy 4. Coordinate with estate planning. Work with an estate planning attorney to ensure your assets are positioned to maximize step-up basis benefits. This might involve changing ownership structures or titling arrangements. Strategy 5. Evaluate business succession. For business owners, step-up basis makes a significant impact on succession planning. Heirs who inherit a business get a fully stepped-up basis in all business assets, dramatically reducing future capital gains taxes if they eventually sell. Conclusion: the step-up basis rule is one of the most powerful tax benefits available in the U.S. tax code, yet it remains underutilized because so few people understand it. Families routinely pay hundreds of thousands of dollars in unnecessary capital gains taxes because they weren't aware this mechanism existed. As you plan your financial future and think about wealth transfer, step-up basis should be a central consideration. Whether you're holding appreciated real estate, a concentrated stock position, a family business, or collectibles, understanding and planning for step-up basis could mean the difference between your heirs inheriting $500,000 or $750,000 plus from the same assets. Work with qualified estate planning professionals, tax advisors, and financial planners to ensure your specific situation takes maximum advantage of this opportunity. The rules are complex, valuation